The screens don't crash all at once. They flicker, subtly at first. A currency pair drifts lower. A government bond yield spikes a few basis points. Somewhere in New York, a portfolio manager pauses mid-sentence, eyes narrowing at a dashboard that suddenly looks wrong. In Singapore, a risk algorithm recalculates exposure and quietly flags a breach. No alarms ring, no headlines flash. But beneath the surface, trillions of dollars begin to shift. By the time the public notices, it's already too late. Markets plunge, wealth evaporates, pensions shrink, companies freeze hiring. And the question echoes across trading floors, boardrooms, and households alike: what just happened? Because financial markets do not move randomly. They are not driven by chaos alone. Beneath every surge and collapse lies a network of forces, interconnected, layered, and often invisible to the casual observer. Interest rates adjust in Washington, and property prices in Mumbai react. A geopolitical conflict erupts in Eastern Europe. And oil futures ripple through Asian economies. A tweet, a policy memo, a quarterly report. Each can become a trigger. So, what truly drives financial markets? What are the hidden mechanisms that turn small signals into global reactions? And more importantly, can these forces be understood or even anticipated? This is not a story about luck or speculation. It is the story of a system built on information, incentives, and human behavior. A system that promises efficiency, but often delivers instability. To understand how markets move, we have to go back to why they exist at all. Financial markets began as a solution to a simple problem: how to allocate capital efficiently. In early economies, investment was limited by proximity and trust. If a merchant wanted to expand his business, he relied on local lenders or personal wealth. Growth was slow, constrained, and uneven. Then came the innovation of organized markets, places where buyers and sellers could meet, exchange ownership, and price assets collectively. Stocks represented ownership in companies. Bonds represented loans to governments or corporations. Commodities markets allowed producers to hedge against future uncertainty. At their core, markets are pricing machines. They aggregate information, millions of decisions, expectations, and data points into a single number: price. But price is not just a number. It is a signal. It tells investors where capital should flow. If a company shows strong earnings growth, its stock price rises, attracting more investment. If a government appears unstable, its bond yields increase, signaling higher risk. Over time, this system creates a feedback loop. Capital flows toward efficiency, and inefficiencies are corrected. At least, that is the promise. To understand how this works, imagine a simple mechanism. A company announces higher profits than expected. Investors interpret this as a sign of future growth. Demand for the stock increases. The price rises. That rising price attracts more attention, drawing in additional investors. The cycle reinforces itself. Now reverse it. A weak earnings report triggers selling. The price falls, fear spreads, more investors exit, the decline accelerates. This is the basic plumbing of financial markets. Information flows in, prices adjust, and behavior amplifies the movement. But this system relies on a critical assumption: that information is accurate, timely, and interpreted rationally. And that assumption is where the first cracks begin to appear. As markets evolve, new layers of complexity are added. Central banks emerge, controlling interest rates and money supply. Governments introduce fiscal policies, taxation, spending, regulation. Globalization connects economies, allowing capital to move across borders instantly. Each of these elements becomes a factor influencing markets. Interest rates, for example, act as the gravitational force of finance. When rates are low, borrowing becomes cheap. Companies expand, consumers spend, asset prices rise. When rates increase, the opposite occurs. Borrowing slows, spending contracts, and valuations decline. Think of interest rates as the price of money. When money is cheap, risk-taking increases. When it becomes expensive, caution returns. Inflation adds another layer. Rising prices erode purchasing power, forcing central banks to react. These reactions, often in the form of rate hikes, can trigger cascading effects across markets. Now introduce geopolitical events. A conflict disrupts supply chains. Oil prices surge. Transportation costs rise. Inflation accelerates. Central banks tighten policy. Markets respond. Each factor is not isolated. They interact, often in unpredictable ways. This interconnectedness is what transforms financial markets from simple pricing systems into complex adaptive systems. And within this complexity lies a hidden flaw. The flaw is not in the mechanics themselves, but in the assumptions underlying them. Markets assume rational actors. They assume participants process information logically and act in their best interest. But in reality, markets are driven by humans, and humans are not always rational. Behavioral biases, fear, greed, herd mentality play a significant role. Consider a rising market. As prices climb, investors begin to believe the trend will continue indefinitely. This belief attracts more buyers, pushing prices even higher. Eventually, valuations disconnect from reality. This is the paradox. The system designed to reflect value begins to distort it. The same mechanism that drives efficiency also creates bubbles. And when the correction comes, it is rarely gentle. The catalyst can be small, a missed earnings forecast, a policy shift, a liquidity crunch. But because markets are interconnected, the impact spreads rapidly. To understand this, imagine the system as a network of nodes. Each node represents a participant: banks, funds, corporations, individuals. If the network is stable, the system absorbs the shock. But if vulnerabilities have built up, excess leverage, mispriced risk, overconfidence, the shock can cascade. This is how localized events become global crises. The mechanism is not mysterious. It is structural. Let's walk through it step by step. First, a trigger event occurs. Perhaps a sudden rise in interest rates. This increases borrowing costs. Second, leveraged investors, those who borrowed heavily, begin to face losses. They are forced to sell assets to meet obligations. Third, asset prices decline due to increased selling pressure. Fourth, falling prices trigger margin calls, demands for additional collateral. Fifth, more assets are sold, accelerating the decline. Sixth, confidence erodes. Investors withdraw capital. Liquidity dries up. Seventh, institutions begin to fail. What started as a policy adjustment becomes a systemic event. This chain reaction is not theoretical. It has played out repeatedly across decades, across markets, across continents. And yet, despite these lessons, the same patterns persist. Because the drivers of markets are not just economic, they are psychological, political, and technological. In the modern landscape, these factors have intensified. Technology has accelerated information flow. Algorithms now execute trades in milliseconds. News spreads globally within seconds. Social media amplifies sentiment, turning speculation into momentum. At the same time, financial instruments have become more complex. Derivatives, exchange-traded funds, structured products, each adds efficiency, but also layers of opacity. The paradox deepens. The tools designed to manage risk can amplify it. Consider passive investing. Index funds track market performance, allocating capital based on size rather than fundamentals. As more money flows into these funds, large companies receive disproportionate investment, regardless of valuation. This creates a feedback loop. Bigger companies become bigger, attracting more capital, reinforcing their dominance. But what happens when the trend reverses? The same mechanism that drove growth can accelerate decline. Crypto markets offer another example. Decentralized, borderless, and driven heavily by sentiment, they demonstrate how quickly narratives can influence price. A single announcement can trigger massive inflows or outflows. The underlying pattern remains consistent. Markets respond to a combination of information, incentives, and human behavior. So how can this complexity be understood? The answer lies not in predicting specific events, but in identifying the key variables. There are four fundamental forces to watch. First, liquidity, the availability of capital. When liquidity is abundant, markets rise. When it tightens, stress emerges. Second, leverage, the use of borrowed money. High leverage amplifies gains, but also losses. It increases fragility. Third, sentiment, the collective psychology of participants. Optimism drives expansion. Fear triggers contraction. Fourth, policy, decisions made by governments and central banks. These shape the environment in which markets operate. These forces interact continuously. High liquidity combined with strong sentiment creates bull markets. At excessive leverage, the system becomes unstable. Policy changes can act as catalysts, either reinforcing trends or reversing them. Understanding markets, then, is not about forecasting exact movements. It is about recognizing patterns. When liquidity expands, risk-taking increases. When leverage builds, vulnerability grows. When sentiment becomes extreme, reversals become likely. When policy shifts, the entire system recalibrates. This framework transforms complexity into structure. It allows us to see markets not as chaotic, but as dynamic systems governed by identifiable forces. And it reveals the central paradox at the heart of finance. The mechanisms that drive growth, liquidity, innovation, connectivity, are the same mechanisms that create instability. The system does not fail despite its design. It fails because of it. So when markets move, when prices surge or collapse, it is not random. It is the result of forces interacting, amplifying, and eventually correcting. And that brings us back to the flickering screens. That moment of subtle instability was not an accident. It was the culmination of countless decisions, policies, and behaviors converging. The portfolio manager in New York was not reacting to noise. He was witnessing the system adjusting, rebalancing itself in real time. The algorithm in Singapore was not predicting the future. It was detecting a shift in the underlying structure. And the global market response was not chaos. It was a chain reaction, triggered, amplified, and ultimately inevitable. Because financial markets are not just about money. They are about how humans process information, respond to incentives, and interact within a complex system. Understanding this isn't about predicting the next crash or chasing the next rally. It's about recognizing the architecture beneath the surface, the forces that shape outcomes, the patterns that repeat, the risks that build quietly over time. Once you see it, the noise begins to fade, prices become signals, volatility becomes information, and markets transform from unpredictable forces into systems that can be analyzed, questioned, and understood. Not controlled, not mastered, but understood. And in finance, that is the difference between reacting to the world and seeing it before it moves.